Did you know that you can invest in stocks as young as 18 years old? Warren Buffett, the world's greatest investor, bought his first stocks at 11 years old. Well, that was in 1941. But you get the point. There are a lot of people like you who wants to invest in stocks as early as possible but don't know where to start. As most people know, the stock market is a very dangerous place to play with your money. It's volatile or unpredictable, which could make you lose your investment in a matter of minutes, if not seconds. So, in this video, you will learn about the common investment mistakes you can make in the stock market and how you can avoid them. Welcome to Capital Finance. Before we begin, make sure to like this video and drop your thoughts in the comments section below. So, let's dig right in. Number 1. Don't invest money you can't afford to lose. Investing excites many people. I understand what you mean. You may see lots of figures. You want to go in and get it done quickly so that your bank account is stuffed with those amounts. However, there are additional things to consider before you invest your money. If you need the money in the next 6 months or so to pay your basic expenses, then it's not worth it to invest in it. Here's why it's important. Even if you invest in a large, well-established firm, the stock market is unpredictable. And if you suddenly find yourself in need of cash, you may have to sell your investments at a loss. So don't get too thrilled. Start as soon as possible, but be reasonable about the amount of money you intend to invest. Starting with a lower but more regular amount is preferable, even if that amount is only a few $100s each month. Number 2. Taking too long to get started. Investing is a long-term process. The more money you put in early, the more money you'll make later. By the time you are 40, a $100 investment made when you are 20 will turn into $466. But the same $100 investment made when you are 30 would turn into just $215. That is supposing you put money in an index fund yielding 8% annually. I know you're thinking, let me wait till I figure everything out. But that moment will never come. Again, if you don't understand what you're doing, you shouldn't invest in it. But you don't have to be a financial expert before you get started. When it comes to investing, index funds are a good option for those who aren't familiar with them. The best way to get started is to begin with a little amount of money from your savings or monthly paycheck. As soon as you have a better understanding of the market, you may begin to invest in firms that you will feel outperform the S&P 500. I understand that you may not have the time, but you don't need to spend hours a day searching for firms. At least once a month, but ideally twice. And once you've found a winning investment, stick with it. ETFs make up the bulk of many people's investment portfolios. To avoid wasting too many waking hours on the daily task of monitoring the performance of your individual stock holdings, you may also invest in smaller firms. Number 3. Not knowing the difference between investing versus trading. Beginners who are just starting out in the stock market believe that they must locate fresh and exciting stocks to invest in on a daily or weekly basis. In the area of the stock market, there are investors and traders. Instead of investing, traders aim to benefit from market volatility by purchasing stocks and then selling them shortly after they've been purchased. You've probably noticed how quickly stock prices change. Every minute, if not every second, they are bouncing up and down. For example, if you bought a stock at $10, then it went up to $15. Trading with $50,000 will get you a $25,000 profit in a single business day. What appears to be a straightforward method of earning money is rather complex to put it into action. In the short term, stock values are nearly difficult to foresee. You don't care about the quality of the firms you invest in as a trader since you don't intend to retain your money in those equities. That's why it's so distinct from investment. Investing is purchasing little portions of important businesses that develop value over time. Instead of reading countless financial reports and devoting your time to evaluating endless financial statements, you may want to stick with one firm that is performing well and has a clear vision for the future. Number 4. Emotional investing. People become suddenly interested in investing when the value of a certain item rises drastically, even if they weren't before. This is similar to what occurred with Bitcoin and Ethereum a few years back. Many individuals who had no understanding of what cryptocurrencies were, how blockchain works, or the technology underlying it suddenly decides to acquire Bitcoins and Ethereum with the hope of making a lot of money. I'm not saying anything terrible about Bitcoin, blockchain, or cryptocurrencies, but if you're going to invest, don't do it solely on your emotions. A lot of the time, it ends in failure. As an example, consider the 2008-2009 mortgage crisis. It was impossible to resist, and even the most qualified investors joined in. It all went down, though, and some nations are still feeling the effects of that financial catastrophe years later. Yahoo in the late 1990s invested billions in Broadcast.com, which was forced to shut down 2 years later. Mark Cuban, on the other hand, was clever enough to sell off his entire stake before the firm went under. Here is a general guideline. If it's already making headlines and prices are skyrocketing, it means you've lost your chance. Accept this and don't beat yourself up over it. Any investment you make should be based on a realistic assessment of the risk involved, and only then should you proceed. Yes, you may miss some excellent chances, but you will avoid the danger of losing all your capital and develop a long-term portfolio. Investing in Google, Amazon, and plenty of other excellent firms was a squandered chance for Warren Buffett, the best investor in the world. When it comes to investing in stocks, there are 2 categories to consider. If a firm is expected to grow in the future, its current stock price reflects its current worth, not its value in 10 or 15 years. And secondly, an undervalued stock. Other than that, you probably don't need to spend your money on anything else. Number 5. Lastly, inability to look beyond the stock market. You can also invest in real estate. However, they're also not the best. You may also opt to put your money in the bank and get less than 1% interest every year. However, this isn't smart, as inflation would lower its value. As a result, you should invest in solid organizations that have space for development. As far as the market is concerned, the most you can hope for is 8% to 9% yield. Even though every year is unique, the S&P 500 has seen spikes of up to 25%, while also seeing dips of the same amount or worse. On the other hand, returns can be in the hundreds or even thousands of percent when making a little investment in a tiny firm that appears to be successful. Unlike these multi-billion-dollar businesses, which are completely out of your control, you have the capability and ability to impact them. Don't let the stock market deceive you. The ideal investment for you may be right in front of your face. If you are new to investing or have a strong interest in it, kindly bear in mind the following mistakes. I know it hurts so much to lose everything you've worked so hard for in a split second. Even if losses are inevitable, reducing them is an important element of success. This is especially true when it comes to the stock market. Thank you for being all ears until the end. Make sure to subscribe to Capital Finance and click the notification bell to get updated on my latest uploads. See you next time!